the last hour trading, 3 o'clock, we have the run up into what? The volume imbalance. So that starts the show. Do we get respect of that level, and does it hold back price? Yes, it does. It starts to go lower. What are we looking for next? What's the next clue? The swing low here, we do what? We trade through it and come back up into what? A fair value gap? Well, there's one here. But what's below that? Before we get to this fair value gap, after this swing low is taken, right there. But it didn't close below it. I never said it had to. Go back and watch what I teach as a market structure shift. All it needs to do is pierce. But what if it's only by one tick? It pierced it. That's all it is. You're literally going in and you're waiting for this swing low. Why this swing low? Because we've already went into what? That volume imbalance with the expectation that we're going to trade to 4098.50, which is the last public reference that I gave on Twitter. We're looking for the markets to gravitate lower. We were expecting the large range day. I told you we would get a big large range day if we got through what? The new week opening gap in front of you. Volume imbalance. We trade up into it. We create a swing low here. We rally up, hit it one more time. What's it hitting? What's this candle's high here? 4109.00. Trades back up to this level here on this candle's high. What is the high in there? 4109.00. Oops. Perfect. Perfect. So when we trade up into that volume imbalance, we want to see it do what? Respect it and repel price away. So when that candle closes and the next one opens, we're looking for no return back to what? Where they removed any mohawk in the lawn. No little seam. So it can go back up and bump that volume imbalance once more. It could easily go up in and trade consequent encroachment too. That's absolutely permissible. But going above this high, not permissible. So it's building barriers. How do you trust the ICT to leave the stop where you put it at? And how do you know that the market's not going to go past? I'm teaching that right now. This turning point here is confirmed when this candle fails to make a higher high than that one, or even touch back into that volume imbalance. And then this candle's low is taken out on that one. When we see that, I'm expecting, and when I'm watching things like this in price action, when you watch my recordings, I'll say, okay, I expect speed and distance right now. Or I'll type in, it's going to drop hard, or a sharp drop now. That's what I'm looking for. We would be getting that here. So we now have this low taking out. This is going to act much in the same way that this candle here being pierced here, it's like a small little shift in market structure. It's an early confirmation that this is most likely going to get tripped. So it prepares you to get ready. So this candle drops below this low. We're looking for this low to be pierced. It does. So now we have a valid shift in market structure with this low being taken there. Yes, you would frame this as a fair value gap, but you don't know when this candle opens and how it closes that creates this what? Volume imbalance. So in my mind, I'm going to use this volume imbalance on this candle here. If it opens here, as soon as it rallies up into that between this candle's open and this candle's close, as soon as it trades there, right then and there, while that candle is bullish, it's green, it's a bullish candle, I'm going right in there, selling short. That's how I would use that entry technique. Oh, but you didn't do it, ICT. You're cherry picking. Look at all the examples. I'm selling short in up candles. I'm pyramiding entries when I'm bearish in up close candles. When the candle's forming, going up, I'm selling into that. How do you know to trust it? I'm explaining it here. You have to know those PD arrays that I'm teaching you to look at and observe and study. You don't know which one you're going to trust. I trust all of them. They're mine. You don't trust them yet. When the market pierces this low here, this would be my original entry. What happens if it would have traded up in that fair value gap? I would have added more. But you're adding to a losing position. No, I'm not. I'm building a position within a small little segment of price action below an area where I don't think it's going to go back to, which is what? The volume imbalance. So I'm framing the logic of yes, I would enter on this volume imbalance as soon as it went into it. But what happens if I didn't have that volume imbalance? I'd be trading into this area here. So I'm putting in my largest position initially here. So if I go in with, say, 6 contracts here, then I'm going to add what? In this area, I would add 3. I'm cutting the original position size and leverage in half. And then as the market breaks down, we see it trade below these lows. We have a lot of energy here, and it comes back up and closes here. I want to see this immediately overlap that wick. Why? Why would I want to see that? What have I been teaching you about consequent encroachment in wicks? Midpoint of that gap can act as what? Support and resistance. So we do not want to see this candle open, come back down, flirt with this midpoint here, and then start to rally back up. That's not what you want, because what that's occurring, where it's occurring, doing it is below old lows. And what that means is it could very well retrace back up, and the human error of not thinking that you're going to have that fair value gap traded to, it could do it right there. And then had it done that, then I would consider, well, I can put on 1 contract and then hopefully not see this volume imbalance retraded to and get stopped out. But that's the risk that you open yourself up to. How do you know? You don't really know. It's just you've been doing it for so long. You use the logic that repeats over and over again most times, not all the time, most times, and then you trust that experience. So in this case here, this candle opens, delivers, and re-delivers this entire range of that wick. And we close lower and have a lower low than that one. So everything's good. Then we open down here, we have a volume imbalance. We trade lower, then we retrace back up. Midpoint of that gap, consequent encroachment. Now think, what do you see here? I swear I wish I had this when I was coming up. I could literally sit here and watch this. Like, if someone was talking like this, I could watch them all day long. Like, I love this. Like, I love price action. I love analysis. I love being in it. This wick here, we measure that here. So that's consequent encroachment at 4100.75. What's the open on this candle here? I'm sorry, I said open. What's the close on that candle? 4100.75. That's consequent encroachment. And the open on this candle is the same thing, 4100.75. Okay, big deal, right? But it goes up a little bit. Why is it doing that? Remember, it's to make it seamless. It's not going to go and bump up right to the old lows exactly all the time. Because if it was like that, number one, I believe it would have been more easily observed by other people. They hide it by having this little bit of an overlap. Because if it always stopped in the middle of the wicks like this, people would have it in books. Years ago, it would have been in books. It's not. It's not in books. Here's your algorithm kicking in at 10 minutes to 4. There's buy side right here. So you have a volume imbalance here. I would use that here and allow for price to trade up into consequent encroachment of this wick. So this would be a point of adding more. And then if it could get to consequent encroachment, I would add more there too. But you're adding to a losing position. No, I'm not, because I will be net short from up here in this volume imbalance, and I have all this position here with the largest portion on initially in that volume imbalance there. So 6 contracts short here, it trades down, comes back up, volume imbalance, 3 contracts, 1 contract, consequent encroachment. Where would I not want to see price trade to now? The middle of this up close candle, because that's your bearish order block, up close candle prior to this move lower. So there's displacement after that. We've taken out that low. There's no need to come back to this level if it's going to go to those 4098.50 level I mentioned on Twitter. So it's you're reading the tape, you're reading order flow, you're weighing out whether or not that the market continuously keeps balancing and repricing, balancing, repricing. So it's permissible for it to trade up to this level here. It does so. So now what has happened right there. From here to here, I gotta change the color of this. We had this range back and forth between this candle's high to this candle's low. We trade all the way back up to this candle high, and then we leave the range here. There's no necessity to enter back into this range if that target 4098.50 is in fact, here's your buy side I just told you I was going to reach for. The target of 4098.50. So because this is a balanced price range, why doesn't it have the necessity for price to come back up into that pink area? Why shouldn't it go up there? Because the price has done what? It's delivered paint down, then up, then down. Buying and selling pressure had nothing to do with it not going back up into that level. It didn't even come back to touch the bottom of the range, which is this old low here, which is what? Classic support and resistance, right? Classic support and resistance. Support broken, turns resistance. Well, you missed the party. See you later. Consequent encroachment of the wick. That's where algorithmic smart money composite men engage right there. And we don't need it to come back up here because this candle went down to this low. And the next candle, it happens to be opening up here and delivers once more over top that range. So what's occurring here? This balance range, balance price range, yes, it's balanced, but now we have a smaller balance price range here. It doesn't need to come back up into this area. It trades lower and then trades over top of it here again. We leave that range and we come back up. What can it do? What's permissible? Halfway. Halfway, which is also consequent encroachment of that wick. There's a convergence of factors coming there. When I'm looking at price, my eyes looking at all these things and I'm reading everything from each one of these candles. Now imagine what I've already said here. How much time would it take me to annotate that in a chart? Typing it out. I can't. Not when a 1 minute chart and I'm trying to read it and decipher all that stuff. I can't do it. So when you're watching price, you're looking at it and you're deciphering, does the feedback that you're getting from price supporting the idea that it wants to keep going lower? The fact that we don't go back up into this area is great. The fact that the bodies are respecting the consequent encroachment of that wick and the mean threshold, because we're measuring bodies of candles here, both consequent encroachment and mean threshold converge at the same area, which is this level right there. Look. $41.00.75. That's the close and open of that candle. The small little variance in price, you have to allow for that. Don't let that scare you. Don't let it be a source of fear or anxiety. That's normal. That's a normal thing in price delivery. Get this off here. So now price goes up into that area. We want to see, and I would be saying, if we were doing a live trade, I'd say we want to see it deliver and go lower now. It goes down. So what's it doing here? It takes out this low here. So now this low to this high here becomes what? A balanced price range. Because the market has delivered both directions of buy side and sell side. Between this here, our old range, down to this low here, the market trades back up to what? Consequent encroachment. So consequent encroachment becomes the high end of the new balanced price range. Because we've traced back that far, there's no need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint the same section of the wall 5 times? No, you're wasting paint. Price isn't going to waste time. Time is important to it. It only has so many trading hours in the day. So you take your eye and your attention. You don't want to do this when price is trading live because you'll miss what you're supposed to be focusing on. But you want to be referring to it while watching price. So again, we're thinking I'm sorry, I thought my son was calling me. We're thinking that the price is going to continuously go lower. The market trades back up into this consequent encroachment here, which is now the new high of the balanced price range. There's no necessity for it to trade higher. Does the willingness of price reflect wanting to go lower? Yes, it does. It takes out this low here, and then we come back up. What's permissible? If this is a balanced price range, it's painted price down, offered sell side, then it offered buy side to the area where we're expecting to see price go to anyway. Then it should go lower. It does. It leaves that price range. Can it go back up into this range? Yes. How far? Halfway. Because we're measuring bodies, we're looking at it through the lens of what? Mean threshold. And I should have charged you money for this. So here is the mean threshold, 4097.50. That's what could reasonably be traded to, and it's permissible. It means it's allowed. You can expect that, and it doesn't upset anything. The market fails to go there, and what does it do? It trades lower than that low now. So we're expanding our range, and it breaks lower. We don't even need to go back up to consequent, mean threshold. We're looking for now any further advancement lower. What does this area here now become? Between mean threshold, which was never hit, this to this is your new balanced price range. Does market want to trade away from that? It does. But now we're late in the day. What time of day? 15:24. So it's 24 minutes after 3 New York local time. It's going to run. It's going to aggressively reach to the liquidity it's going to aim for the day. Aggressively runs, trades to whatever 40, 78 and a quarter becomes. It hits it at what time? 15:34. So 34 minutes after 3. And then 20 minutes to 4. You want to be sitting and waiting for price to run on liquidity, because at 15 minutes of, if you haven't already seen it by then, it's going to really aggressively run on liquidity that has not seen or hasn't been tapped into. Meaning what? I told you the buy side liquidity would be right here. Where does it go? Right there. And now we're at a time of day where it's just going to trade listlessly now between this high and that low. And simply because the market's moving around and fluctuating and it ain't 5 o'clock yet, retail traders are going to try to trade in that and get caught up in a mess. When the only thing it's done is create a low, we come off the low, and it does its simple macro. It repeats over and over and over and over again. But reading price and understanding the order flow is essentially what I'm showing you here. Every time we have an overlap of price. If sell side's offered, it means it's going down, a down candle. If you're bearish, you want to see that down close candle be redelivered with an up close price movement. And then back down. It does not need to close. It doesn't need to close with an up candle if it was a recent down close candle. So what do I mean by that? What will be an example of that? All right, say how we have this down close candle here. Say the next candle opened up and we traded up and overlapped all of that and then went down and made a lower low. And so it will have a wick there. That's the same thing as what I'm saying. Is it has to have both, every range between one price level and another to be there, to be determined and deemed efficiently delivered, is between both price points, between any price point range in a price run. It has to offer both directions. It went down and up, down then up. Or if it starts with up first, it's up then down, and it has to overlap the entire range of whatever has been delivered. So that's what I've walked you through here. Unless someone does what I just did, you don't know what I'm talking about. And these other folks out here trying to pretend they know what I'm teaching, they have no idea what they're talking about, because they're never doing that in their videos. They're never explaining what it is that makes the market efficient or inefficient. If the market trades back and forth between price points that are defined as I'm teaching you, if they deliver both directions, that's efficiently delivered price. When it doesn't do that, it creates these things like this, where you have a separation from one candle's low, one candle down, the next candle is a lower high than the previous candle's low on these three candles here. So a fair value gap is three candles. The identification of the inefficiency is always the candle in the middle, and you define it by the candle prior and the candle after. And that segment of price action in between becomes your fair value gap. Okay, so that's your fair value gap. It does not mean just because we go up here like we did here, is that a short? No. Why not ICT? Because it's a fair value gap. You should be selling short there. I should be able to do a pyramid entry there. Well, no, you shouldn't. And why would you want to add or enter a position that's been going down all day long at 11 minutes to 4? You don't want to do that. You never want to fade afternoon market reversals like this that close to 4 o'clock, because many times it'll ramp up against you because what? It's going to want to induce short covering. Why? Why would they want to do that? Because they want to have order flow coming in so they can, the composite man, can use that order flow to balance books. There's commerce coming in. It's not just all speculation. There's transactions that are coming in all the time. I'm talking about currencies here. I'm sorry. Like if you're looking at trading the currency market, but they're going to use specific times of the day, like London close, between 10 o'clock in the morning New York local time to noon New York local time. They'll use that little window of time to facilitate order flow coming in that London close condition allows all of that new volume coming into the marketplace, short covering or selling longs. That order flow, they use that for the commerce aspect of Forex. So again, it's not all just speculation and traders like us sitting around trying to make money on different fluctuations in price. Sometimes it's just real business needs when it's relating to currencies.